Price. That's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Bruce Liu manages Wooji, Esoterica's NextG economy ETF, which invests in 5G and its enablement of the new digital economy. Having spent time at WisdomTree, Bernstein, PhaseCapital, and the Dow Chemical Pension Fund, Bruce's research technique was honed at some of the most prestigious sell-side and brokerage firms on the planet. Now he puts that to use exploring possibly this decade's most compelling investment trend. 5G and the technologies leveraging this next-generation connectivity are revolutionising industries in pursuit of the new digital economy. We discuss sub-themes like edge computing and cloud, as well as the companies at the vanguard of this disruption, think Sea Ltd and AMD. Bruce concludes by explaining how Wooji offers diversified exposure to this market megatrend and analyses the fund's 140% returns since inception. Enjoy.
Welcome to the podcast, Bruce. It's great to have you on the show. So how are things in New York?
Thank you for having me. It's a great pleasure. As you can see there, New York City looks beautiful now. We had a thunderstorm, actually not thunderstorm, just a very bad storm yesterday. But now it's just come back to normal.
Yeah, great.
It's a beautiful summer out there.
It looks lovely out there. Yeah, actually, we're having one of our better days, 22 degrees and sunny in England, which for us isn't too bad. Bearing in mind it rains 90% of the time. So I'd like to start by asking a question that won't necessarily flow chronologically, but it will give listeners an early indication of one of the focuses of today's interview. So why, in your opinion, is 5G the biggest investment opportunity of the next decade?
Okay, that's a very fair question. Before answering the question, I want to make it very clear. The way we look at 5G is not only the 5G technology itself. To us, it's the 5G cycle. So if you're looking back, we went through 3G cycle and the 4G cycle, especially the 4G cycle. Everybody knows it's mobile internet. It started from 2008, I believe, and roughly ended at 2018. So look at what happened during that 10 years of time. And it basically changed how people communicate with each other. You basically live on your smartphones, right? And we got Ubers, we got Netflix, and many, many other things. That only happened because we have the mobile internet. So, the significance of 5G cycle, again, it's a 5G cycle, is you broaden that up. It's not only about connecting the people. It's already been done in the 4G cycle. And it's more about connecting things together. I think that's the significance of the 5G cycle. It enables way many things. And to support that scenario, those are business cases. It actually is a process of disrupting the infrastructure, the whole technology stack we built up during the 4G cycle and getting the new ones. Now everybody has heard, moving to the cloud, and we generate the data, not only from the center of the cloud, also on the edges of the cloud. Well, when 5G comes into play, and you're gonna get more data generated from all over the place. Well, you need to communicate, process data, transport data, and make it useful. Not only in the center, again, it's coming all over the place. I think that's the significance of the 5G cycle. And it enables the changes from the very basic like a semiconductor level up to the computing architecture until to how the software processing the data. Until I don't know how long it's going to take, when later on across all the verticals, you're going to apply that and having the new business cases, user cases. To me, it's not only 5, even 10 years process. It's probably even longer than that. Hopefully this, at a higher level, this answers the question.
Yes, no, absolutely. I think that's a really good high level answer, as you say, and we'll dig into some of those sub themes. and smaller topics as we progress. But before we get stuck into that, I'd like to get a better understanding of your career history to date, just to give the listeners a bit of context in terms of who you are and to give the interview a bit of context as well. So I believe you started your career at Dow's Chemical Pension Fund, or at least that was your first position within the asset management space, it would seem, based on my research. And before moving on to cover institutional research strategy at Sanford C. Bernstein, now part of Alliance Bernstein, that firm, that second firm there, I mean, they're recognized as one of Wall Street's premier sell-side research and brokerage firms. I wonder whether you could just give us an insight into the research process and techniques you were able to learn and hone during your time there, and actually whether you've taken some of those skills and methods on into your later experiences as well.
That's a very, very good summary and also very good question, Hayden. Well, yes, and towards the end of my PhD study, and I found like my interest is more on the industry side rather than the academic research. So I worked my way through the institutional investors, and they finally got a chance. That's a very rare chance to directly go to the a big pension fund at the Dow Chemical. The reason they hired me because at the time we were building up our absolute return program, and they needed somebody who has the PhD background to be able to do very advanced analysis and research. Well, to be honest with you, I stayed almost like 3 years over there. That's the best place you can imagine to learn things, to start your investment careers. And we allocate 80% of our money to the external managers, which gives me the opportunity to learn from like guys like Bridgewater, D.E. Shore, the top hedge fund manager you can imagine. Well, at the same time, I get a chance to manage 20% of money internally. And myself and my boss, it's a very small team. We were giving the, huge responsibilities at a very early stage of my career. I'm very grateful. Even now, I still like keep in touch with them. And a lot of like what you mentioned, a lot of investment process and the framework we are using today. Actually, I started building them up and learn from in that time period. Well, I truly appreciate one thing there, from there, because it's a small team, we couldn't do really like an in-depth security level research at that time. But we spent so much time understanding the cycles, both market cycles and the business cycles. That makes me realize how important the cycle to your investment performance. And how like later on, I'll tell you a story. Another reason actually I left Dow Chemical because I feel, I learned so much about the cycles, macro factors, which can, affect multiple asset classes. Then later on, towards my career, I realized, I still like equity markets. I want to understand the business, the companies, to the depth. And that's why I made a move, to the Sanford Bernstein. As you mentioned, that's the firm it still is regarded as one of the top, sell-side research firm. They certainly live up to it. I joined them covering the portfolio strategy, and for the U.S. large cap, we're there. I get a chance to meet all the very talented research analysts covering multiple sectors. One of our partner at Esoterica, Yang Ren. He used to be cover semiconductor over there. And so I made tons of friends. Over there, I learned how to analyze, fundamental companies. Also gives me the opportunity to really combine the macro view, the cycles with the fundamental research, which is the essence of the investment process we're using today. Hopefully that makes sense, Hayden. I'll stop here a little bit.
No, that combination of kind of the macro level view with the fundamental research, you've now taken that forward, and that's what you employ at Esoterica. I think that makes a lot of sense. And it sounds like actually the perfect grounding for a career in asset management, actually.
Yeah, I'm very, very grateful. I feel I consider myself for being a very lucky guy. I didn't in the first 5-7 years, I learned a lot, and that I don't take it for granted.
No, absolutely not. Well, then, your next role was equally as interesting. I think you go on to work for WisdomTree as an equity strategist. So again, sort of refining your focus on equity markets rather than sort of all asset classes, I suppose. And I wondered whether you were given a specific sector to look after during your time there.
The reason I joined WisdomTree back then, that was, at that time, WisdomTree was booming because they're like, new currency hedge products. They got a lot of money. They try to beef up their research capacity. I saw that as a good opportunities for me to do something more meaningful. Really, like, you basically a lot of like actively managed stuff they have right now. We built over, back then from scratch. That's the part I appreciated the most. You really build something from the ground up. I think we don't really have very specific sector focus. It's more on the on the whole market. You look at the market from different perspectives. Not only from the fundamental perspective, also from the factor perspective. That's something I built up through my PhD study. So I still talk to Jeremy a lot, and he gave me a lot like a freedom to do things that I feel like, making sense for investors. Also the ETF vehicle, my love for ETF actually more coming from there. I got to know the industry a lot better and appreciated the beauty of that a lot more. And so that's also a great, like, stepstone for me to come to where I am now.
Yeah, okay. And then to sort of round off your career trajectory, then your position, or the latest position before joining Esoterica, was as partner and portfolio manager at PhaseCapital. I wonder, it's not a firm that I'm familiar with. So what sort of products did Phase sort of specialize in, and can you tell us about your time there as well?
Yeah, well, that's where my entrepreneurship, spirit came out to play. Towards the end of my tenure at WisdomTree, some colleagues and friends from Alliance Bernstein, and they came out and took over a small hedge fund from Boston and moved it to New York City. Basically, that's a multi-assets, macro-based, hedge fund strategy. And I was managing their equity part of the book, So that's that. But I appreciate that part. I appreciate the opportunity to grow in a business with your friends together, and see what that takes. Start a hedge fund, and what are the struggles, and can you do? I actually learned a lot. That also links back to why I feel like, especially in the US market, ETF has a great potential rather than the very traditional hedge fund business model.
Yeah, okay, great. Well, then you leave that position, and in 2019, you're CEO of Esoterica, and that is the position you obviously still hold today.
Yep.
So I want to move on to sort of discussing the firm's philosophy and what differentiates you, I think, more importantly, from your peers.
Mm-hmm.
The company seems to focus on next generation investing. That's how it's described on the website. So firstly, perhaps you can just explain what that means.
Okay, I would love to. This is how I see the whole industry. There's a lot to talk about here. Back then, towards the end of 2018, I had this idea. We were discussing what to do, for the next cycle, and that was not that obvious back then. But within the friends, now partners, and we were thinking, we were convinced 5G cycle, the new cycle is going to start, and we should focus on that. But how should we deliver that? Should we do it in a very traditional hedge fund structure, or should we do something different? We actually made a very conscious decision. We want to do it in an ETF format. For the very right reasons, with PhaseCapital, I realized how difficult, to get funding, get money, for a new manager. The whole hedge fund industry I think it has peaked. It's going downhill. That's the whole industry thing, the headwinds. And we saw that. But on the other, I came from the pension fund, like endowment. I know how the folks are thinking and what they're doing these days. Everybody is in the de-risking phase. They're not, in the mood of allocating the new monies to the new managers. Now alone to talking about the new strategies. But on the other hand, this is true for the whole asset management industry. The money is more coming back to the individual's hands, right? So take a pension, for example. You used to have DB pension plans. Companies is taking care of you. Now everybody is moving to the 401k, defined contribution plans, which meaning you have to take care of yourself. This is true everywhere now. And the money is coming to the individual retail investors' hands. But they are not well served at all. Nobody is, the whole industry, I think that's a shame. The whole industry is still it's close-minded. Everybody still wants to, I want to focus on the bigger pension funds, big endowments, big insurance companies. I want to serve those folks. When I was at Dow Pension, I got emails, research, phone calls all the time. But retail investors don't have that luxury, but they need help. That's where I see the opportunities. I'm not joking. I always talk about the friends and the other strategic partners. Why we want to do an ETF? Because I want my parents, my sisters, my friends are able to participate a product I feel comfortable with. If I always get asked many times, Bruce, shall I buy this stock? Shall I sell that? Now things become so easy. Whenever I get a question like that, I feel confident to tell my friends, you should just buy WUGI. I put all my best ideas there. Truth be told, and I put my sisters, my mom's money, and my personal money all into that WUGI. And I think this is fun for the long-term investment. I feel comfortable doing that. So that's the standard I hold when we managing the portfolio, or even for the future when we have the new products. The first question I'm gonna ask: do I feel comfortable putting my mom's money into it? But that's I say the whole industry is coming to the ETF. Also, ETF industry is changing as well. I saw this we went through 3 phases. The first phase, you got a product, but it's very plain vanilla, and the beta product, SPY, EEM. Those products are still designed for the institutional asset allocators. That's how they allocate their capital. Then you went through the second phase. You got tons of, say dividend-driven, earnings-driven, quality. In the end, that's one kind of a product. That's just the factor-based, ETF products, strategies. Those are also designed for the institutional investors, right? If I talk to my mom, my sister, they don't understand what that momentum means, what the value means, what the quality means. You have a hurdle to cross to really communicate that. That's just now for the retail investors. Then I think we're come to the third phase of ETF business. And if you really want to serve retail investors, you have to engage them, give them a product that they can understand. So individually, I think most people invest by themes. Okay, I like, for example, digital economy. Although I don't know AMD, Nvidia that well, but I understand what they're doing. That's a lot better than just giving people a quality or growth portfolio. And I just feel that's why we focus on the thematic investing and the digital economy. 5G-driven digital economy is the first product we are thinking of. And that's also a place you can really combine the active research and the ETF structure together. Yeah. So that's what really inspired us. And I feel I think this is at a very early stage. And that's where we are going to devote our energy and time to for the next decade.
Yeah, I think that was absolutely fascinating. You certainly seem to be ahead, or at least you were ahead when you started Esoterica and you started the fund of that trend, i.e. where people were opening up, they were being more transparent about how they allocated money, and they were trying to figure out how to create more intuitive products for the retail market. I think there's still a way to go, but I think Wooji, for example, is a perfect product for people that are actually probably quite sophisticated and very intelligent in their own right, in terms of they have very successful careers in whatever industry they work in, but they aren't necessarily financial experts. And I think that's often missed with some of the more jargon heavy funds and products out there that obviously you mentioned. So yeah, completely agree. And that's certainly something that we talk a lot about here at Opto as well. And it seems that's the sort of product that would serve potentially a younger generation. I mean, do you try and focus on that demographic within that wider target market?
Well, although we are saying we're trying to fight, serving the next generation. The two meanings actually. One is we are investing in the next generation things. We look forward. Yeah. And you want to focus on the areas that has a huge TAM, total addressable market, and the growth potentials. But of course, we want to serve the younger generation. I feel like investment is not something you learn from school. And you have to come out of school, making a little bit of money, start practicing. In this environment, when you have to take care of your own financial well-being, you want to start early, and you want to find a good mentor, a coach. I was lucky when I started my investment career. I found my mentor, Dr. Don Rich. Unfortunately, he passed away last year, and miss him a lot. I thought I benefit a lot. Somebody who knows what's going on and willing to spend time with you and talking through things that hugely, accelerated my growth in my business. Well, now maybe we cannot do it on a one-to-one basis, but that's why you see we publish research, publish contents all the time, because I want to let people understand how we, as a professional money manager, how we look at the market, how we look at the companies, how we look at the new trends through our content. I think that's a good way to engage. I wouldn't say it's educate, because I want to make it like a two-way communication, but at least like the young folks who are willing to learn, to understand this particular domain, they get a chance to say some high quality stuff. I take it as a personal mission. Sometimes it's not about money, but I feel like I'm very proud if we can make this success. And you go out there making effort to educate the public and let them be more, able to and equipped to measure their own financial well-being. To a certain extent, you don't see us writing about WUGI per se, because I'm perfectly fine. People just coming to our website, see the research, and even they just pick the stocks in our portfolio. That's perfectly fine. I just want people to learn what that takes to manage your money well.
Yeah, no, I think you do a fantastic job of that. I read quite a lot of the white papers on your website, and it goes beyond just sort of talking about the investable opportunities and the themes and the sub themes you're exposed to if you are invested in the ETF. There's stuff like how to create a 3-fund portfolio. There's asset allocation for diversification, and even one paper on how to construct a portfolio, which is quite a basic level concept. That's it's perhaps for a beginner, someone that's not invested before, still someone sophisticated enough that they can understand the concepts, but someone that is new to investing per se. I wonder whether then you target explicitly beginner or intermediate kind of retail investors more than you target institutional money. How does that work?
Okay, that's also a very, very good question. At least as the Esoterica brand, the ETF products we have so far, yes, I have to agree with you. That's more focused on the retail investors. Just we design the product like that, and we publish the contents just to serve them rather than the institutional investors. But that does not mean we just exclude the institutional investors. For example, we do have the SMA accounts. We also have the hedge fund solutions to serving. We don't have like a pure institutional investors yet. But we do have the very sophisticated family offices with us, stating us. And so I can say we develop like 2 product lines. One is more for the institutional investors, but they also appreciate the insights we bring for the new growth opportunities. They are looking for the those long-term growthy names and the industry sectors to invest in. So our knowledge there is very helpful. And also we manage the ETF products. That's more for the retail folks, and it's really long term. The way I look at it is the holdings we have is really for the long term investment rather than the short term trading opportunities. We don't if you look at WGI's portfolio turnover, I believe the latest number we maintained below 20%. That's really low for actively managed products. But it doesn't hurt our performance actually. If anything, I think it helps. We have the courage and the conviction to hold through. This year it's not easy for the growthy portfolio, right? And we went through the middle of February, March, and the May, and even a little bit of July. All the growth portfolios were under pressure for the macro reasons. Well, I think we're doing quite fine.
Yeah, well, I'll say we'll get on to performance shortly because there's some really interesting points to pick out there as well. Well, I think that's a good probably juncture then to move on to kind of what Wooji is invested in explicitly and return to that question that I asked right at the top of the episode. So firstly, is 5G really a step change compared to fourth generation wireless communication technology, in your opinion?
Honestly, I think it is, and it's not just like extension of like 3G, 4G anymore.
Yeah.
The scope of 5G is really, really like, a huge step function.
Mm-hmm.
It's no longer only about the speed, and it's also about the low latency, because it has the user case implications. A lot of things, if you don't have that kind of like a low latency, this whole 5G thing is not helpful at all. Autonomous driving in the end, I think that could be a huge, application. Also, the capacity. When you are truly trying to connect everything together,
mm-hmm.
well, you need to have that kind of like capacity rather than just limited like a number of like smartphones get connected. I wouldn't be surprised, at the end of like the 5G cycle, everything you can imagine in your home, on the street, in your city, on the manufacturing floor are connected. By default, everything are connected. So in that sense, 5G is creating a much, much larger
mm-hmm.
opportunity set for the world. That's how we see it. It's really digitalizing every corner of our economy. I think that's the mission of 5G. When they design the 5G protocols, I think they have that in their mind. It's not only about the cell phone wireless communication protocols. They have those like vertical implications in mind.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Yeah, absolutely. Well, okay, that's probably a good point then to talk about what a 5G-enabled global digital economy might look like. I guess to make this less abstract for the listeners, what do you think? I mean, maybe there's a few sort of big changes you see from today's economy versus what a 5G-enabled digital economy might look like. What are the biggest sort of updates and implications this technology might have?
Okay. Well, a lot of people actually were asking that questions because they feel everybody got a smartphone, we're connected. So like a 5G, yeah, sounds interesting. Might be just faster, and you can do something more on your phone. The phone is smart enough.
Mm-hmm.
What else, right? And look beyond this. Like what I mentioned earlier, that's for the 4G cycle, mobile internet. People get connected. Now it's all about like getting things connected. Like manufacturing, that's one example. Healthcare, hospitals, and even the smart cities, all the things out there, they're not connected yet, right? And even the stuff, your TV and your fridge, and are not connected. Some people done that already, but most of them, you just don't, you haven't done that yet. There are a lot, potential connectivities out there. I think that 5G is trying to capture. Yeah, and 5G is gonna really making everything connected. Well, connected is only one thing. More meaningful thing is when everything get connected and you need to respond, timely, no latency, no delay. That just generates tons of data. You can imagine in your mind now, like, in the economy you are living in, the society you are living in, every corner everything is connected. They are generating data instantly, all the time, right? So that's how we look at the 5G opportunities. Forget about the verticals, the application. Just think about it. When you are living in a society, in a world, everything is connected. You got data over you. How you first generate data, then transport data, then process that data. Eventually, maybe you have to store those data. And, that's how we see the opportunity sets. And it's coming from the 5G cycle. Yeah. I'll give you some examples. And first of all, of course, like a smartphone is early, thing, like everybody was talking about 5G phone. It's interesting. But within the phone, to enable that 5G thing, you need much better semiconductors. Phone itself, in the 4G cycle, we didn't have the smartphone before 4G cycle. Apple basically, invented that, right? So that marginal change is from 0 to 1. So that's huge. That's why Apple benefited so much through the 4G cycle. But from the 4G to 5G, that's different. Everybody got a smartphone already. All you need to do is just upgrade your phone. So that's no longer a 0 to 1 process. It's just upgrading. So that's why in the 5G cycle, we're not that bullish on the phones at all. But what has changed is, to enable 5G and all the applications it might be able to achieve, the semiconductors in your phone has to, professionally, what we call it, semi-content. The number of chips has to increase, significantly. And the quality of the sophistication of the chips have to increase significantly. So that's where the opportunities and people should play. And also another example, in the 4G cycle, still most of the time the thing works. On your phone you get an application, right? You run your application and it sends signal to the cloud. It's somewhere in the central cloud. Yeah. Then it sends this. It got a processor. It sends a signal back, and that's how you use your application. But in the 5G cycle, when some certain applications, just use like autonomous driving or your VR, AR gaming, or even some very sophisticated manufacturing process, it requires latency. It requires very low latency. I think that's intuitively easier to understand. You spend so much money, effort on all the engineers make your phone is 5G enabled. So, but all you need to do is really just connect the phone to the, we call it the radio access network. It's on the edge of the whole thing, right? The computing power. It's only on the edge. 5G only improves the speed and the latency, this part, right? That's not enough because you still need to, if you still keep your main application in the central cloud. The data, the signal, goes from here to the radio access network, then from the radio access network to the central cloud. That becomes a bottleneck. Sometimes you just cannot deploy your application that way. So that's why these days everybody is talking about edge computing. So you have to a certain extent, you have to move your computing power, moving your application to the edge, making it as close to your edge devices and users as close as possible. So that's something is changing. I think eventually, we're still in the process of building the cloud, computing. But what's new in the 5G cycle is it's not only in the central cloud. We're gonna see the deployment of the edge cloud computing. And plus all the softwares and the applications supporting that. Hopefully that makes sense.
Yeah, that makes a lot of sense. Yeah, you've done a really good job of sort of summing up the impact that this can have holistically, not just as 5G as a single application. I think you've rightly underlined that obviously infrastructure is a massively important thing, and there's certain elements within that. You've got semis that you talked about, cloud computing architecture as well. You mentioned edge computing, but those all, I guess, contribute to the architecture that is needed to have a 5G enabled next generation economy or digital economy. So I think that's absolutely fascinating. With that in mind, then, I suppose there's going to be other technologies that will leverage this next generation connectivity. So once that architecture is there'll be technologies on top of that can leverage it. That's, to me, and this could be wrong, another opportunity to the investment opportunity in the companies that are building the architecture. It's another side of it and another way to access this theme. Perhaps you can talk to us about that other side of the opportunity.
That's a very good question, and that's how we formulate our investment thesis for the next. Well, that's the exact reason. I don't think this is like a 5-year thing. It goes way beyond that. Maybe in the first 5 to 10 years, you build the infrastructure, the things we mentioned earlier. And once you have everything right, just in the 4G cycle, without the mobile internet, we're not going to have Uber. We are not going to have some, those delivery services, Grab, right? And that sort of things. And the same thing, once we have the 5G infrastructure ready, being able to, enable all those applications to realize the full potential of 5G, it's gonna be adopted by different verticals. Easier to understand right now, maybe a lot of people are talking about the gaming. Mobile gaming is already, big thing, right now. But in the 5G cycle, it can go even bigger. People like to discuss like a metaverse, right? You live in the virtual world. So imagine when you really do that, you got AR, VR, all kinds of things, it requires fast speed and latency and tons of data. I think that the 5G infrastructure is the basis for that. Well, people like to talk about the remote like surgery. I actually believe that's a key thing for the healthcare industry. Sometimes even today we're constrained by the number of doctors, and they're physically constrained. They're not going to able to serve the broader audience. But when you are able to remotely doing a lot of things without any delay, and that just release the potential of the healthcare sector a lot. The productivity improvement. So think about that. That's huge. And I believe 5G and related stuff are going to be a big part of that. Now to mention, because to me 5G is new, new incremental opportunities more coming from the business side rather than the consumer side, because this part needs more work, manufacturing, smart city, even the agriculture. I just couldn't imagine how they use it, but I believe when the time comes, and those are the areas we're probably gonna see something like really innovative changes based on the 5G and all the computing power it brings.
Yeah, absolutely. I hadn't considered that sort of consumer and business split. I think that's a really important point. And if we just finish on one more point on this opportunity as a whole before we get into your investment process, I guess again, to me, it seems there's a tertiary opportunity here, which is the amount of data, you mentioned it earlier, that needs to be processed as a result of these changes being made. I mean, 5G will result in masses of new data being produced. So is this where the software companies come in? And are we going to see developments in that space? Are there going to be interesting investment opportunities in software equities as a result?
It's huge. This is actually very broad like a segment. Let's just focus on handling the data and make it more friendly for the 5G AI are two things that they cannot live with each other. They're driven by the same thing, same underlying development. And once you have the tons of data, if you want to get anything out of that, you need AI, you need machine learning, right? It all comes together. But to enable that at a large scale, when data is spotted everywhere, you need a software infrastructure to support that. That's particularly the reason we like Snowflake. They're building the data cloud. Of course, AWS has one. Microsoft has one. Big players has. That's a huge growth potential. We only see the tip of iceberg at the moment. Anything related to that, handling the data, make it more useful for the machine learning, and we think the growth potential is huge. That's also the reason we like MongoDB to a certain extent, and any infrastructure play to support that. I think some companies still in the private sector, and like Databricks. Those are also the things we appreciate a lot.
Yeah. Okay, great. Well, let's move on to your investment process then. But before we discuss the Wooji ETF explicitly, which of course gives investors exposure to all of the themes that we've discussed so far, which is fascinating, I'd like to just briefly cover any sort of overarching principles that inform Esoterica's investment thinking. So I read that you look at 4 main sectors or categories within this overarching theme that we've discussed so far. Namely, you've got new semiconductors, that's 1. You've got cloud and edge computing, number 2. SaaS, number 3. And number 4 is an enabling technology. So in terms of your investment process, what's the purpose of breaking it down in that way?
Well, honestly, that way it's an easier way to communicate with like retail investors. what's in this 5G cycle? They can imagine, okay, yes, semi is in there, computing architecture in there, and new SaaS names are there. And then at the end, 5G enabled applications are there. So that's the easy way to communicate. But when it comes to investment process, no matter which sector, which theme we are working on, could be semi, could be the cloud, could be SaaS. At the end of the day, we focus, you have to look through it. We are looking for long-term compounders, meaning the company that can grow 20%, 30%, 40% for the foreseeable future. They have the potential to expand their margins. They have the pricing power, right, to help their bottom line growth. We call those are, compounders. All we do, no matter across the themes, the sectors, the industries, the only thing we are looking for are those, long-term compounders in our portfolio. So at the end of the day, why we spend so much time, energy and those in-depth, fundamental research. So that's exactly what we're looking for, long-term compounders. And we felt in a 4G cycle, you can say Salesforce is a long-term compounder. And who could be the 5G cycle in the semi space? And we feel Netflix and AMD are, because they are able to really grow their TAM and at the same time expand their margins. And they're continuing to execute well. So that's fundamentally what we're looking for. And that's not different from many other good, high quality, active management, no matter it's mutual fund or it's hedge fund. But I think what makes us special is our true understanding of cycles. Yeah. True understanding of cycles. Research has shown that, let me say it this way, because you can say me now. Long-term compounder is you find somebody here and it's very small. You hope in the 10 years or 20 years, their earnings or their sales growth is getting to this point, right? So that's the growth you're looking for. But the company, when it comes here to there, it's not like a straight line. It's not linear because we're dealing with the market. A lot of times, market is volatile. It's impacted by not only your fundamental reasons, it's impacted by many other factors, macro factors, interest rates, and some external shocks like COVID that can also impact the performance of the equities. Even Salesforce, Microsoft, if you look at their fundamental growth, it's a straight line, but their stock doesn't work every year, right? Yeah. For the particular reason we just mentioned. So as a portfolio manager, finding the compounders is only the first step. You make sure all your companies you hope they can deliver fundamentally, they can deliver this kind of growth. But you also need to be able to manage the cycles. When the cycle is right, you have a conviction to bet on them. When cycle is off, because sometimes this year is actually a perfect example. Starting from in the middle of February, market went through a process of really betting on the value and killing the growth, right? And so that's a lot growth in names under pressure. And it has nothing to do with the fundamentals of those growthy companies. Right. It only because, the macro factors, in this case particularly, is the yield curve. The yield curve is steepening huge. Very fastly. And in that environment, investors, as markets as a whole, actually favor small cap, favor value factors. So for us, finding the fundamental long-term compounder is the first step, and managing the cycles and to try to generate alphas, amplify that long-term compounding power is the second step. That's how we combine those two things together. As I mentioned earlier, right? I learned how to understand the cycle from Dow Chemical Pension, and the way as a team we learned how to do the fundamental research at Alliance Bernstein, and now everything just comes together. We keep fine tuning our investment process, because that's another thing. To have a long-term sustainable investment success, as a money manager, you have to be able to adapt. The things can change. The macro environment has changed significantly since 2008. The environment is just no longer the same as before. So you have to change your process, how you look at the valuations, how you evaluate the growth, how you look at the cycles is totally different now. I think that's what we are working on.
Yeah, just that second point about sort of managing the cycle. I suppose, if your conviction is there in terms of the company growing fundamentally and compounding over time, so now you just need to manage your exposure to that company depending on how the market more generally will perform. Is it then just a case of just managing your kind of allocation and the weighting of that stock within the wider portfolio, but never actually truly coming out of the stock? Or do you actually sometimes find yourself exiting a position to then come back in at a more favorable entry point? Like how does that functionally work?
That's a very, very good point. Think about this. At this point, even starting from last year, when the yield curve is steepening, and that's a very, very favorable environment for the cyclical sectors. And in our portfolio, that's more related to the semiconductors, right? And so that's why we overweight the semiconductors. And within the semiconductors, we used to have more cyclical names. Now we do not have them anymore. Why? Because cycle has moved on. Curve is no longer steepening, and curve is flattening and consolidating, which meaning the market is moving on, appreciate high quality names and even more. So that's why if you look at our portfolio right now, we have more focus and concentrated on the high quality names. So that's how we look at the cycles and try to combine that with underlying stocks. And it's going to be reflected on the weightings of stocks. But sometimes, if we find a more interesting names and it fits into the cycle, at the moment cycle, we put that into the portfolio. And if not, we wait until cycle has changed and we're waiting for the better opportunities. Sometimes the adjustment to the weighting also has something to do with the fundamentals. I have to admit that, when we started, we had the AMD as the top holding at some point, and we cut it, and later on we added it back. It's all about the development, the whole semi space, the Intel, the dynamic between Intel and AMD. It's, if we have time, we'd love to dig into it. That's quite an interesting story to tell.
Yeah, great. Okay, well, maybe one for a follow-up podcast then. So if we just dig into that active management point then, and let's discuss the investment process now explicitly with the Wooji ETF in mind, and we'll get onto the performance of that ETF. We'll finish on that point as well. But first off, I read on your website, 5G is not a light switch, it's an evolution. So the technologies leveraging the next generation of connectivity are fast evolving. This is a very fast changing space and environment. So we've talked about active management already, but how active does this ETF and the management of the portfolio need to be to generate meaningful returns?
Good question. And when people think, especially retail folks, when they think about the active management, they always think about you're trading all the time. Mm-hmm. You in and out all the time, try to generate. To me, a lot of times you're just trading noises. Mm-hmm. I don't think that's how we generate, returns. Yeah. And when we say active management, probably we mean active research. We discuss ideas and we look at companies, industry on a daily basis. We're doing in-depth research on a daily basis. Mm-hmm. All my analysts are, both in US and China. They think about those and what could be the next player, who would be the winners in this particular industry all the time. I call it active research. We discuss ideas, 3 times a week, as a group. And now to mention the, daily communication, they talk to the, companies, and sell-side analysts and the experts all the time. That takes effort. That's active management, or I prefer to say it, active research. I think, if you do that, you can, you're on the path to the success, hopefully, rather than just sitting there looking at the stock charts. Mm-hmm. And in and out, trying to catch the benefit from the volatility. That's not how we do it. It's reflected from our portfolio turnover. We don't have much turnover, But when we need to make a move, and we make a decisive move. Yep. That probably different from some other thematic active ETFs. They might trade a lot.
Yeah.
I personally don't know how much value it has added to the portfolio and performance, but I think we are going to stick to our way of active management.
Yeah, no, I think it's a really important point. I think it does differentiate you. I mean, everyone hears stories about ARK with Kathy, obviously trading in and out of Tesla every day, multiple trades, a lot of volume going in and out of that stock, for example. So I think it's interesting to identify that actually, no, you have a conviction in a portfolio constituent and you, by and large, you stick with it. And in terms of identifying attractively valued, well-positioned companies, the companies that are going to make it into your portfolio, are there any sort of consistent fundamentals or characteristics that characterize the sorts of companies in your portfolio?
Yeah, and both qualitatively and quantitatively. And first of all, this is a growth portfolio. We favor growth. We're looking for growth. So what really matters to us is this company able to grow in the next sustainable way in the next 5-10 years. So that's the most important criteria we're looking at. It's actually very intuitive. Do they have a very good TAM, total addressable market, to attack? And that really just limits their sky, right? You can tell. Second, are they industry that you want to be in a good neighborhood, basically. And also in that neighborhood, you are the leaders, and they all has the potential to become a leader. So at the end of the day, all that matters is you can translate into the sustainable top line growth. That's number one. Well, having the growth is only one thing. Are you able to, eventually translate that into the bottom line, the earnings, which takes, tremendous pricing power and also operating leverage. I think that's the art of investing in, growthy names. A lot of names at the early stage, they have to invest, right? They have to invest in sales and marketing, R&D to expand their market share. So if you just look at their bottom line, horrible. They don't have earnings. That scares a lot of people if you're only blindly looking at the valuation metrics. But if you do your research, you look into the fund companies, you look at the industry structure, their competitive advantage. If you have a conviction, you believe they spend money now because they need to get to to gain the market share, and you believe going forward when they get all the market share, when they need to expand their margins, they are able to do that. Well, that's where your research comes from. You have to. That's how you differentiate yourself from others, and being able to identify those companies. Like take Netflix for example. 5, 7, 10 years back, and everybody was criticizing them. Amazon, even today, people are criticizing them like spending too much money. Yes, top line growth looks good, but they don't make any money. They even had to borrow money to grow. But look at it now, and Netflix is turning into a cash cow. They're gonna become, free cash flow break even, very soon this year, according to the management team. You can see clearly they are able to grow, and they are also able to expand their margins. That's where we like operating leverage, and I think that's a much safer way, sustainable way to gain the investment value. We do not like a financial leverage, and it just doesn't make much. You are putting yourself into a lot of unknown risks.
Yeah. Okay. And in terms of the securities then that you select, are you limited by any geographies, or are you? I mean, you mentioned that you've got analysts in both China and the US. Are those the two markets that you tend to focus on within the portfolio, or is it completely global? How does that play out?
We are actually very open-minded when it comes to that, and we do not really just limit us to Asia and the US markets. And but although those are two markets we're most familiar with, so you want to stay where you know the best. So we're less familiar with the European market, for example, and the LATAM. Maybe we are building up our expertise there, but not to the levels. And it's really finding the companies fitting into our thesis and prove themselves to be the long-term compounders. and participating this digital economy in a meaningful way. As long as they are qualified and by those criteria, they should have a seat in our portfolio.
Okay, great. And which, if we think about the current portfolio as it stands right now, and obviously it's changing some of the time, but which sectors or industries are most represented within the portfolio as it stands?
At this moment, we have most holdings in semiconductors. It's more because we are still at the early stage of 5G cycle. When you're building either like smartphone, 5G phones, and base stations, and even the cloud computings, like at the end of the day, it all comes down to semiconductors, right? So that's part of the reason we have most of the semis in the portfolio. But when this cycle goes on, and people have built their infrastructure, and I can say we're moving towards the software and cloud computing even more. And down the road, maybe 5-7 years down the road, you might find that like half of our portfolio are actually in the application layer rather than the infrastructure layer. We are changing the portfolio, according to the cycle and according to the development of this digital economy.
Yeah, great. And that's borne out, I suppose, in your largest position at the moment, I believe, is Nvidia. You've got your second largest is Sea Ltd, which is an interesting company, and it's a Singaporean consumer internet company with numerous verticals. It seems to embody kind of what Wooji is all about, I suppose, offering somewhat holistic exposure to the new digital economy with businesses in gaming, e-commerce, payments, etc. Firstly, is that fair? Is that a reason it features within the ETF?
Yes, exactly. You said it very well. We actually has AMD is also the top holdings, but now we split it between AMD and Xilinx. The reason is we realize there is a huge valuation gap between AMD and Xilinx. Xilinx is on the way to be acquired by AMD. We don't see any reason they could not close the deal. And so that valuation gap is something we feel like, the money left on the table. So that's where, so when you say like our true exposure to AMD, you should, add AMD and Xilinx together. That I think that's also meaningful exposure. We like AMD as a company very, very much.
Good. Okay. Well, let's finish. A couple of questions on performance. How has the fund performed since inception back at the end of March last year?
I think we have done a good job, and we are I don't know the exact numbers now, but probably around 120, even 30%.
I asked the question knowing the answer. I think it's actually above 140% now, at least when I looked since inception, which when I looked earlier today, which is, fantastic performance. It's massively outperformed kind of market and benchmark averages. So that's phenomenal. And the fund, I think, is up 16% there or thereabouts year to date even as well. So pretty decent growth year to date as well. But why do you think the performance has kind of been slower this year? What macro trends and kind of headwinds mean that the performance has been less stellar more recently?
Okay. Well, that's a good question. And I actually am very proud of our performance this year to date. I mentioned earlier in the early part of this year, especially starting from the middle of February, and when everybody was concerned with the inflation, higher rates, real yield did jump quite a meaningful way. That was hurting the growth portfolios, and so that's the macro headwinds. It's true for every growth portfolios out there. If you compare our performance with say ARK, for example, because to a certain extent, I think we're doing similar things. And relatively, I think we are holding up quite well because we did make adjustment. And when cycle goes on, we switch more to the high quality ones. Still maintaining the growth. We want to stay true to our investment thesis. Whoever puts their money in WUGI, they should know this is a growth portfolios. And when the whole growth portfolio is under pressure for the macro reasons, and we're gonna suffer a little bit, just along with anybody else. But on a relative basis, we hope we can do better. And also when the cycle changes, and we can, we call it a convexity. So when market, when the market is down, hopefully we done less, but when the right cycle is coming back, we can up, more. On that basis, I think this year we actually have done a pretty good job.
Yeah, no, I'd say. I mean, it's about relative performance, particularly in a market environment like this, I think. And as you say, I mean, even 16% year to date, even on a kind of absolute basis, is fantastic. But I did actually compare the performance over 12 months, so over a year, to the Blue Star 5G Communications Index. That was noted on your website as a sort of competitor offering, or I guess a product or an index that offers similar exposure. And actually, I saw that was up 29.8% over the past 12 months, compared to Wooji's 36.3% climb. So those figures were taken as of the close yesterday. So even to a product where you've tried to find something that offers the most similar exposure to the product, you still are vastly outperforming that index. So one question to finish on the ETF. What is it about sort of Wooji's portfolio construction? Maybe it's the construction, security election, I don't know. What do you think is giving you that edge against those similar products offering similar exposures?
Okay. Well, although this has to come back to the very original idea, like how you think of the 5G opportunities. In our case, and we look at the cycle perspective, we look at more on the things like 5G enabled. So what it takes to build the whole thing together to digitalizing your economy. So that's our thesis. In their particular case, they're more focusing on the 5G technology itself. So that's why actually, if you look at the components of the portfolio construction, they have like smartphone makers. They have the Ericsson, Nokia folks like that, building the hardware boxes related to the 5G. We do not have those names. Why? Because we do not believe those companies and the sub industries actually can generate meaningful growth in this cycle. When you invest in the growth themes, you want to find the pie that's growing faster, bigger than anybody else. We don't see those opportunities and in those particular industries. I think that's the most important difference between us and them. Also, I hope they do not stay that way, because the whole, infrastructure building is going to end at a certain point. If you just stick to those names, the benefit is gone, and you become you're losing value proposition. Different from like them, and WUGI is going to evolve along with the cycles. Now we have more semis, and because we try to get benefit from this, infrastructure building. But when cycle moves on, we're moving towards software and applications. That's some, the benefit we want to, give to the investors.
Yeah, great. Okay, well, I think that's a fantastic point on which to end the main body of the interview. So we do now have our quick fire questions. This shouldn't take more than 2 minutes. And you can answer in as little as one sentence or one word, if you like, just a lighthearted way to end the episode. So this is a generic list of questions. So they were not specifically tailored to you. We asked the same questions to everyone. And the first one is potentially a tricky one, but what is the top mistake investors make, in your opinion?
Top mistake, being too confident. That's always the top mistake.
Yeah, good. Heard that one before. Definitely agree with that. Question 2 then. Where do you go for investment or economic insights? Do you read specific publishers, for example?
Well, this is a good question. What I learned, it really depends on where you are in your professional cycle. And I just remember where I learned all my macro stuff. And at that time, I had the opportunity. We invest in Bridgewater. They published this fantastic, daily observation. I got it every day. For 3 years in a row, I read every single one of those. I even replicate every single chart of their reports. That's how I build up my, macro, knowledge base, which now I benefit hugely from there. And, maybe not everybody can get that kind of reports, but principle stays. Find high quality, source of those kind of research, put them out Even now, I think I believe they put out that like kind of the things on the website, and just find those and read them in depth, and get your hands dirty. In this industry, it's not only about reading. You gotta get your hands dirty, do things, do analysis, put numbers in, really look at the cycles and try to analyze performance. Get your hands dirty. Not only about talking or reading. If that makes sense.
That does make sense. Yeah, definitely. Okay, so question 3: what is the most memorable moment from your career to date, do you think?
Well, I have to say now it's the day we launched WUGI. That's totally a new chapter of my career, and hopefully we can keep doing this. I'm very proud of the team.
Yeah, definitely. Okay, penultimate question then. If you could go back in time and give yourself a top tip to learn from and to live by, what would it be?
Professionally?
Yeah, I think so.
That's a tough one. Well, probably stay more disciplined at, meaning, have the routine and stick to that. Read more, doing more, and stay more disciplined.
Yeah. Okay, great. And our final question then, this is sort of the Opto question. We aim to speak to the fund managers, the individual traders, individual investors that are outperforming benchmark returns. So we ask everyone, what is an investor's best source of alpha? So if you had to narrow it down to one thing, where do you think the great investors derive their outperformance?
Understand the cycle better. I think that drives a lot of returns. When you need to put
You summed it up so nicely. No, feel free to flesh it out.
No, I think that's good enough. And when we have if we have other episodes to do together, I'll talk more in detail. But I think understanding the cycle is way more important than just picking one or two right companies.
Yeah, no, completely agree. And a nice message to finish the interview on. So thank you very much, Bruce, for joining us on the podcast. It's been a real pleasure.
Thank you for having me. I had a lot of fun.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.
Co-Fruition.